Good afternoon, everyone. Welcome to today's webinar. Today we are covering data integration mastery and the subtopic unlocking insights by combining multiple sources. I am Danielle Pendleton. I am the VP of Delivery here at FPN. I'll be your moderator today for this session, and we are very excited to have all of you here with us today to go over some really amazing content. Before we get into the actual content today, I want to cover just a couple of housekeeping items. For your sake, I know I always wonder this when I'm in a webinar, your microphones and cameras are off by default, so no need to worry about any background noise. Questions are welcome. I've stated that before, and I'll continue to let you guys know that. Drop any questions you have into the Q&A panel anytime. We'll keep an eye on those and save time at the end for live responses or throughout if they become applicable to the current topic. Today's session is being recorded. We're going to share the replay and any other resources with you after. And if you run into any technical issues, please let us know in the Q&A. We will do our best to help. Today's session is all about moving beyond siloed data. If you've ever felt limited by depending on a single data source, be it credit, property, demographic, digital behavior and footprint, or even the non-public resources like the MLS, you are definitely not alone. We are going to explore how integrating multiple data sets gives lenders and brokers a more complete, actionable view of every borrower. You're going to hear why transactional methods fall short and how combining data leads to smarter decisions, more meaningful borrower interactions, and stronger business results, which is what we are all here for. We're keeping things very conversational today. This is a deep dive, definitely not a lecture. We will not be doing any didactic instructing here today. Our presenters are going to walk you through real-world examples, practical strategies. We're going to save a lot of time at the end for your questions, and again, throughout if necessary. Goals today: by the end of today's session, you will walk away with a clear understanding of the strengths and limitations of individual data sets like bureau, property, mortgage, public records, insights into why single source transactional approaches leave gaps in borrower understanding, a framework for combining data sources to enable deeper, more accurate analysis, ideas for using integrated data to build more relational, borrower-centered interactions, and practical steps to implement a data integration strategy that drives growth and efficiency. So now that all of that is out of the way, I'm going to introduce you to our fantastic presenters. We have two speakers with us today. Ryan Moore is our Chief Operating Officer here at FPN. He's been with the company since 2014 and has played a very pivotal role in shaping operations across both our consumer and enterprise divisions. He was instrumental in the 2022 divestiture of FPN's Resident Link platform, and he is widely recognized for his deep expertise in consumer credit. A little bit of background on Ryan: he brings over 20 years of financial services experience from previous roles at Regions Bank and New View Trust Company. He is a frequent speaker on how credit data can improve customer lifecycle, and he holds a Bachelor of Science in Finance from the University of South Florida. Joining him is Ivan Ahmed, Senior Director of Product Management at Experian. Ivan leads mortgage prospecting suite within Experian's housing business and played a key role in bringing their property data asset to market. Prior to Experian, Ivan co-founded a fintech company in 2015 that was later acquired by a major bank, and he brings deep experience in both front-end and back-end software solutions for banks and mortgage institutions, and he continues to drive innovation across marketing and acquisition solutions. With all of that said, we're going to go ahead and get started. So Ryan, I will hand it over to you.
Great. Thank you, Danielle. Appreciate that. If you looked at the agenda, I wanted to start quickly with just a quick little recap. For those of you, in past ones, I've looked at the attendees. This time I'm just the presenter role. But when I looked at the registrations, I saw we have quite a few folks that are joining us again. But some folks that are joining us for the first time, which is always great. And so I just wanted to point out that this is a part of a larger webinar series. This is a deeper dive, as Danielle mentioned, into some pretty specific blended data discussions with Ivan, who's clearly an expert in that way. So I want to briefly recap maybe a couple of the ones that we've done before. There's one on pre-qualification. We did another one that was a little bit more pre-screen focused. Ivan was actually on that one as well, and really helped walk us through propensity data and some of the upcoming changes with trigger legislation. And I just want to kind of expand out to the kind of the loan life cycle concept, that everything we're talking about, for the sake of time and your sanity, since it's some pretty detailed stuff, we're going to use some pretty specific examples. But while we might focus on maybe a mortgage transaction, or we might focus on a particular type of data set, the concepts that we seek to get at can be used across the entire consumer loan life cycle. They can be used within different industries. So again, we'll bend a little mortgage based on Ivan's experience and FPN's client base, but these are not restricted to mortgage. Depending on where you're at, single source data, pulling a credit report, for example, obviously an incredible valuable part of, say, the pre-qual process. However, knowing that person's income is also important, right? Similarly with pre-screen, right? Single source data gives us a lot of great information, but it doesn't always give us the big picture. So throughout this, right, we're going to try to continue to move. We won't be able to address the whole life cycle. We won't be able to address all the products, and we certainly won't be able to address all of the data that's available. So we're going to cherry pick some examples throughout, but just understand that these concepts can be applied, more broadly here. So when we talk about single source data, and like I said, we're going to cherry pick some examples. I think it's very clear that everything that is on the screen here, right, would be something that most of us would consider valuable to know or to understand, right? So in our three little bullets here, Sally consumer is actively shopping for homes online. This is real data that we really get access to on a regular basis, and it's absolutely meaningful. Knowing that somebody is actively shopping for a home, browsing online is obviously an unbelievable show of potential intent, right? We've got another example here where we've got Frank. Frank recently listed his home with a realtor. Again, very real data source, very real marker that a lot of our clients, I'm sure Ivan, your clients as well, look for information like that. I think we'd all agree that we'd love to know that information. And then finally, we've got Jane here. Jane consumer has got excellent credit and she qualifies for a mortgage. So those are fantastic data sets. I think we would all agree. But when that's the only data point that you have, and you don't get a bigger, more broad, complete view of that consumer profile, then it opens up the potential that it's not all it's cracked up to be. So, well, Sally just turned out to be just looking with no plan to buy, and she has poor credit. Frank, he is moving, but he's moving to a state that you're not licensed in. Again, picking on the mortgage example, right? Not all of our mortgage companies are licensed in every single state. And by the way, he also wants to rent when he gets there, learn the area, whatever the case may be. And take Jane. She had walk-on water credit, but Jane doesn't have any desire to move. And if she stays, we could look at a refi, right? But she doesn't have any equity in her property. So in circumstances like this, right, we're talking about single source or siloed data, right? So we've got this excellent data source. There's no two ways about it. Any one of these data points is incredibly valuable, but alone, it doesn't give us much of a picture about the consumer other than one element. And so the key is to learn from each data point, to bring in multiple data sets so that we can get a much more a deeper understanding of who that consumer is, what they're actually interested in, and hopefully market to them not only a product that's of interest, but a product that they would qualify for and at a time that they want it. So this is where we go from the single, kind of siloed single data source to a multi-source or integrated data, right? And so if we take a very similar example, but instead of looking at three individuals with three disconnected data points, let's look at one individual that is tripping these alarm bells across multiple data sets. So in this case, we have Mary consumer. Just like our previous example, Mary's actively shopping online. The difference here is that Mary also listed her home for sale with a realtor, and Mary has excellent credit. So yeah, I know this is a cherry-picked example, and examples always prove out what we're trying to get to. But if we can take these concepts of individual single source data sets and understand how they actually work together, we can increase our understanding of the borrower. We can get a better sense of, are they ready to buy? What does that timing look like? And even with great borrower information, and I'm sorry, great potential borrower information and timing, if they don't qualify, we still don't have something that's truly actionable. So we need to bring all of these different data sets together to help us understand when to market to somebody, what products to market to them, and are they even going to qualify? And the qualification piece is really big when we're talking about pre-screening, where you have to actually make a firm offer of credit. That firm offer is only going to be considered valid, right, if the consumer is going to qualify for that information. So, and by the way, this is becoming more and more commonplace. I was actually, I chose not to put some quotes on the screen because we have so many things to cover. But as I was pulling, quotes from various experts in various fields, there was discussions of how, at one point in the early 2000s, data was kind of the new oil, and then it was data was more like gasoline, and that it wasn't as effective unless it was refined, and then analytics was the combustion engine that helps us go faster, and really everything is building on itself, and data has become largely commoditized, right? There are many sources to get data, but if you're just grasping at disparate data sets and you're not learning from step 1 to step 2 to step 3, data source 1, data source 2, data source 3, etc., you're going to end up spending more money and have less value in the end, because again, if Mary's shopping online but she's not credit qualified, still not a great opportunity. So as we think through this, again, I think it's pretty clear. So I obviously took the easy part. I got to kick it over to Ivan for the more difficult conversation. But the easy part is integrating data, right? Understanding how that data works together, making sure that each step learns from the previous step, getting us a more complete picture of the consumer that then ultimately allows us to make appropriate offers to that consumer at the appropriate time. But there's actually yet another level to this data. And this is a topic that I'm really glad to have Ivan here to help us discuss, because he's actually on the forefront of this. And this that I'm referring to is not just integrating multiple data sources together, but actually blending data sources together. So I'm going to put a visual up, but I'm likely going to move away just so that we can move this into more of a conversation. Because I'd love to, Ivan, we've had a few of these webinars. Some have been a little bit more presentation format. Some have been a little bit more conversational. We got a lot of positive feedback on the conversational ones. So, with that, let's go ahead and dive into this very, quite frankly, complicated topic, and try to, distill it down into a way where we can really help people understand the benefit of actually blending data sets together. So obviously here I've chosen a credit data and a property data as our sources. Ivan, you and I have talked about these two data sets at length way too many times. Probably shouldn't even admit how many times we've had these conversations. But would you, take us into, let's just pick on one for a second. Take us into credit data. Obviously, you're going to represent maybe the Experian credit data. Historically, things like LTVs have been made available, via the credit data. But what are the limitations if we're using, let's say, a loan to value calculation from a single source credit data, like, again, Experian credit data?
Yeah, it's a great question. Well, first off, thank you for having me. Always a pleasure. And so, I think going back to your previous slide, one, I think, important thing to understand is that there's this notion that you can take data and just kind of squish it together, right? And it's just data. You can compound it, you can put it together, you can ETL it, and you can just start using it. And that's just not the case. And so what stitching together disparate data sets means is really resolving an identity graph issue. And what that means, what those big words really mean, is that as Mary, the consumer, is progressing throughout her consumer life cycle, her journey, is Mary in fact the same individual when she's shopping from when when she's maybe entering a store like Home Depot, to purchasing and actually making a purchase, to actually submitting her information for a credit pull? Is she the same person when her credit's actually pulled from our credit databases? So you're really like resolving this identity graph issue. Is Mary, in fact, who Mary is at every point in that consumer life cycle? And sometimes she's not, right? Maybe there's a name change. Maybe Mary got married. Maybe there's unfortunate circumstances of consumers passing away. So is Mary the actual same Mary? And so you're resolving an identity graph issue, and that's really where the innovation comes in, is understanding how these disparate data sets can be conjoined and combined in a meaningful way. And not just to derive insights, but to make sure that the insights that you're deriving are accurate. So because sometimes the data doesn't really play well together. And so, the big challenge that we have with credit bureau data is that the data furnishers, the lenders and the banks, the financial institutions, they don't typically report, or they actually don't report asset information alongside the credit information. So what that means is that when there's a credit trade line for a mortgage, or a mortgage is opened up or originated, when that mortgage information is delivered to, say, an Experian, it does not include the information regarding the property itself. We don't know what the property address is. We don't know how much it's worth. We don't know when it was actually purchased. We don't have the document date from public records. We have information regarding the loan itself, the mortgage, the underlying mortgage, the on-time payments, when the trade line was opened, the reporting balances, but we don't have information on the underlying asset. So it makes it difficult for you to be able to make a holistic and macro decision around a consumer when you don't actually have the information pertaining to that underlying asset. And so the way to address that is to take these disparate data sets, particularly around property data, and connect it to credit information. And the way that we do that is that we connect the credit data through metadata on a trade line to metadata on a property record. And what that basically just means is that you're looking at the different characteristics associated to a consumer as it relates to their property, and then trying to tie that into the different characteristics of a consumer as it relates to credit, and seeing if the two are connected, right? So you're looking at when the property was actually recorded as a deed in trust at a local county government through a document date, and then you're correlating that to the actual date that the trade line was opened. But there's typically a discrepancy, right? There's going to be a reporting lag time between when a mortgage is actually open and when it gets reported to a bureau. So how do we know, in fact, that a consumer who purchased 123 Jump Street actually corresponds to a specific trade line that's been reported to the bureau? So there's a lot more work that's involved in being able to conjoin these two disparate data sets than it seems. It sounds very easy on paper, but 2 years of research and development proved otherwise. And so the insights that we've been able to glean from this has been very powerful. Now we have a pretty good understanding of, hey, 123 Jump Street's worth $800,000, but there's actually about $250,000 worth of available equity, and we know that because we know what the house is likely worth using an automated valuation model, but we also know the actual outstanding principal balance, right? And not using the balance that was reported at the time of the deed and mortgage transaction. And that's the challenge that you get when you try to reverse engineer things like CLTV using property records, right? You're going to get a CLTV that's as close as you can get without you getting actual credit bureau credit reported data, right? So you're going to reverse engineer, and using an amortization calculator or table, you're going to back into, what the likely outstanding balance is going to be based off of what the estimated interest rate is, based on what the term was, based on when it was actually recorded. So now you're just sort of guesstimating if there's been any significant principal pay down. Now you've got kind of a stale estimation. So when you conjoin these data sets, you're getting a more accurate, more holistic view of a consumer's financial background and then also their collateral background.
Yeah, and it's interesting because I think there are some misconceptions, right? So even just the idea that the bureau isn't necessarily informed of the underlying asset. So in the case of the mortgage trade, the specific property that mortgage belongs to, I don't think is readily known, right? Because we when we get a credit report, let's say, right, it's got the consumer on it, it's got maybe their date of birth and their social, it's got an address, and then it's got all of these trade lines. But that address may or may not be that property address, right? So that back end work that you mentioned to kind of stitch the two data sets together, I think is often maybe misunderstood, or certainly the complexity of it isn't fully known by most users, because you just have this expectation that, well, of course Experian knows, what that belongs to, but that isn't always the case, and sometimes it's because maybe the data furnisher is not required to report it. Other times, maybe they would see it as being advantageous not to report everything, so that they have some data sets that are maybe unique to them, or some information that isn't completely, known to somebody that can access the credit. So I think that's a really interesting, takeaway, that even Experian credit data, which is incredibly detailed and robust, still is missing bits and pieces that might, allow us to make an accurate calculation. And then picking up on the property data piece, especially, it's it's only a few years in the rearview mirror, right? That we were all, home, and the world was upside down, and everything else was going on. And so not only is a calculation based on property data trying to account for, like you mentioned, accelerated payments and all these different things, but there's also, special cases where there was, forbearances, or, different things that weren't recorded the same way as they would have been historically because of the circumstances that we were going through. So before, you would have seen the 30-60 late, but there were, voluntary concessions made by lenders, and forbearances, right, where the balance is put on the end and the months are extended, or there was a period of time where, when we were getting back online, we didn't actually know what the lenders were going to do. Were they going to start to foreclose? We're going to start to, forbear. So I think it's crucial that we have these types of conversations that point out even two amazing data sources, like, Experian credit data. And by the way, I'll ask you in just a second about the property data itself, but even individually great data sources still have to make assumptions. And it's only in the two working together that we can reduce, maybe not eliminate, but certainly reduce the number of assumptions that are made, so that we can get to the most accurate calculation. So with regards to accuracy, right, I know the answer to this, but what property data have you guys been working with to create these blended credit credit and property attributes?
Yeah, so we work with First American today. First American being a title company, we don't have anything against any of the data purveyors or vendors in the market. We did conduct a data bake-off in 2019, and after a series of sort of internal review and analysis of different competitors, we came to the conclusion that First American offered to us the best preferential terms and quality and coverage of the data that we were looking for. And they've been our partner ever since. The two organizations have been sort of tied to each other at some points in their history. And so they were actually, I think a lot of people don't know that they were actually both the same company until they were split off. So there's some long storied history between the two firms, and they're continuing to be a fantastic partner. They are a title company, so that is their bread and butter business, and then they do also aggregate public record property information.
Well, I think that, we should all strive to learn something new every day. And I literally just learned that at one point they were the same company. That was not known to me before 10 seconds ago. So that's that's very interesting. What I like though that you hit on, and I'm sure that you could probably go on for an hour plus on just what went into reviewing those data sets, like you mentioned in that data bake-off, which is a very creative way of referring to it. But you hit on a couple of things that I think are super important because as our the clients and the potential clients that are hopefully listening here, the blending of the data, as important as that is, you have to start with quality data. And in this case, we talked about Experian data. Now we've talked about First American data. So you mentioned a few things, and correct me if I got them wrong, but the things that maybe we would want to evaluate. So let's say that we're talking about blending totally different data sets, and we were going to try to understand the underlying data itself, right? The things that I heard you mention were kind of three main things: that it be comprehensive, right?
Mhm.
That it have great coverage, and then that it be of high quality. And I can tell you, as a reseller, we do work across all three bureaus, but we've never been the same company. But we have had a long-standing relationship with Experian, and we do constantly have to do our own bake-offs, if you will, where we are, juggling requests from clients and can it be bureau A, B, C, et cetera. And so we've done similar evaluations and constantly come back to Experian, for the depth and breadth of data. So back to my original question though, were those pretty much the three main things that you mentioned, right? The comprehensive nature, the coverage of the data itself, and then of course, obviously, not sacrificing quality for either one of those.
Yeah. Yeah. We are admittedly the best bureau. You're 100% right. Uh, that's correct. So we were really looking at kind of the following key factors, right? So in terms of comprehensiveness, when it comes to property data, there's a lot of data. It cuts across 10 different sub segments, everything from HOA data to PACE lien information to deed and mortgage transactional data to assessor data, to automated valuation models and different propensity scores and underlying attributes and models. So there's a lot of different data that's available in the market. So one of the things that we looked at was, can we find a provider that has optimal sort of comprehensiveness of the different facets of a property? Does it have enough coverage around the characteristics of a property? The roof type of a property. Can we get information on the HOA or the outstanding involuntary liens on a property? A lot of this is available at a public record level, but like sometimes it's not aggregated as sort of an independent data asset that's stitched together. They too have developed their own identity graph that stitches together all of these separate sort of data segments into one serviceable, call it like a very long table. In this case, it being a property ID. So a property ID in this case would be your sort of unique identifier across all of these different disparate data segments. So that's the comprehensiveness. The coverage is a very important part, right? So the thing with public record data is that it's in some sense a commodity data asset, yes, but it is also a data asset that's incredibly difficult to compile and aggregate, largely because there are thousands of county governments that you're working with and city governments that unfortunately are a bit old fashioned in their data retention and aggregation policies. So you've got certain sort of rural counties and cities that they're not very incentivized to develop and maintain technology and robust sort of data retention best practices to be able to make sure that the data is being housed and cleaned and retained and structured properly. Some of them don't even monetize. So I've heard many stories of First American having to go out and fly out local municipalities and quite literally show up to a random county office or a city office and be like, hey, we're here to buy your data. We'll do the work in actually cleaning it up, and someone being met with like a shotgun, right? And believe it or not, even in 2025, that still happens.
Right.
So it's not a small feat to go out and consolidate this data from various different counties. And the other thing to keep in mind too, every county and every government jurisdiction does things a little differently. So you're going to see some fat fingering of the data. You're going to see some anomalies in the data. You're going to see inconsistencies. So a big part of the data is making sure that the data has adequate coverage. And for the vast majority of data subsegments, First American has got, a 90 to 99% coverage rate. And of course, in certain jurisdictions, it's a little lower, but for the most part, it averages out in the high 90s, and that's pretty fantastic. In terms of the quality of the data, what that means is that if we run a query, how likely is it that most of the fields are the actual value of the data contained within those fields are identical in terms of their formatting, right? Are you seeing anomalies? Are you seeing string characters in a numerical field, or vice versa? Or is the data structured optimally for ingestion and usage? Because that's a huge part of being able to actually use this data and being able to map it and conjoin it with credit data more effectively. It's taken years for us to really understand and make sure that's the case. So those would be the sort of three criteria that we looked at when we chose them as a provider. And they continue to they've invested significantly in our use case of the data. And so as a result of that, we've developed a very nurtured relationship in which we're continuing to learn more and more about the data and continuing to refine and improve how it can be leveraged in various credit use cases.
Yeah, that's something that I've actually certainly discussed many times before, and even kind of spoke on the topic. Is there's a big difference. Obviously, we just talked about the data itself, but even the provider of the data, right? There's a very big difference between having a vendor and having a partner, right? And they sometimes they seem as if they're, we're talking as if they're synonymous, right? Because while I'm getting data from this company, or I'm getting data from this company, but that alignment that you spoke of is incredibly important, and especially when we're talking about disparate data sets, especially when we're talking about tens, if not hundreds of millions of individuals that are within those data sets, to get them to talk together, to get them to be able to stitch them together and learn something meaningful is absolutely a challenge. And so I think that I really appreciate you walking through kind of how you work towards selecting what data sets are best. And then also, that highlighting towards the partnership style relationship where they're working with you to refine, to learn, to grow, and to lean into those use cases. Because again, it's very easy to think data is data, but the application of the data also needs to be considered, and for various reasons, not just the efficacy of the data point that we've created, back to where we started for this portion of the conversation around the LTV, right? Having the greatest LTV is awesome, but we also need to be cognizant of there's still rules with most of this data, or I should say all of this data, but increasingly more sophisticated or challenging rules, right? Whether it's the FCRA and we're talking about credit data, or other legislation, even the method that we communicate with the consumer, whether that's via phone or via email or via direct mail or some other type of digital marketing campaign. Each of those carry different rule sets, and so we've got quite a complicated a task here, where we're trying to bring these different data sets together with the understanding of what the use case is, how it's going to be used, so that it can be done responsibly while still having a high efficacy with the result. So I mean it's a pretty big lift, and I know you guys have worked on it for years, and as users of the data, I can say that we've been absolutely thrilled with what we've been able to do by tapping into these blended data sources. I don't think we necessarily maybe could have done it done the stitching together part, but we're certainly grateful that you guys figured it out so that we can, use that data to help our clients in their various programs, campaigns, et cetera. And that identity graph that you referred to, and kind of bringing some of this back to that original example, obviously chose a very simple example for my part. But it is, the more we can know about that person, the more data points we have around, who they are, where they are, both physically and also sometimes digitally, allows us to have a higher degree of confidence that that Mary is the same Mary that's shopping online, is the same Mary that owns that property, is the same Mary that is attached to that credit trade line. And again, I also like to point out, like I tried to say in the beginning, that yes, we're picking on a very specific example, but these are the same strategies that need to be deployed with any data vendor that you use, right? Vetting them for quality and coverage and comprehensiveness, right? When you're thinking about putting two together, do they have the same, if we speak credit language for a second, do they have the same permissible purpose? How is that going to affect the outcome? Do we have any restrictions? Even going back to the data providers, there are unique licenses that come along with them, right? There's a lot of different moving parts here that we need to be cognizant of. And again, as a reseller, somebody that actually uses this data, having a partner like Experian that's done so much of the heavy lifting allows us to take advantage of a lot of these very complicated calculations, for use with our end user clients. So with that, since we obviously covered a lot of ground, I want to just pause, kick it back to you for a second, Danielle. I know we brought up questions in the beginning. I love to have the conversation tailored to the audience if we're able to. So with that, I'll just pause. Danielle, any questions that have popped up that we should try to cover at this time?
We do have a couple, but I think that they will be covered. If not, I can bring them back to the forefront at the end.
Okay, that's fair. All right, so Ivan, the next, I'm gonna go ahead and share again because just to put us back here. All right. So obviously this is what we just kind of covered. Again, not looking to be very heavy with the visuals. I really want to keep this conversational. But so we've gotten an understanding of single source data versus multi-source, siloed data versus integrated, and then the ultimate end all be all, the actual blending, like what you mentioned with the credit and property data to derive calculations like the LTV. But now we've got to figure out how to actually, use this information, right? So even a provider like in this case Experian that's done the heavy lifting, right? It's still, data at this point, right? So as I'm thinking through the process and just kind of hit these topics, broadly, and then we'll kind of hit each one, Ivan, a little bit more clearly. But obviously, first and foremost, you have to have access to the data. Once you have access, you need to identify, right, who it is that you're trying to target. What is that profile of that consumer? What stage are they in the life cycle? What products are you looking to promote? What products are they interested in? The timing element that we talked about. Once you start to put these programs in place, you need to be able to, measure them, right? Are they being successful? Are we getting the response that we expected? And then ultimately take in that information, refine our approach, and, rinse and repeat, right? Come back to the beginning. So I know I kind of just quickly ran through, a pretty big concept around implementing this data. But could you share with us a little bit, right, from a client maybe looking to, work with Experian, right? What type of tools do you have that provides access to this information that we're talking about here today?
Yeah, that's a good question. So we've talked about the data assets. Then I think it's important to kind of touch on the delivery channels and then the types of use cases within those delivery channels. So we allow for this, called it blended conjoined data, to be consumed in kind of the following ways. We can allow it to be consumed in batch or bulk. This is kind of the good old fashioned, we're going to ship you a CSV file or a common, a common delimited file. It can be structured or unstructured. And you take that, you ingest it, we send it to your FTP site, you grab it, you ingest it, you use it as you need. Typically, the data has to be, if it's delivered with PII included, it has to be used under an FCRA use case because this data is credit matched, which means that every property record actually has an associated consumer credit ID, which means that you actually can pull credit alongside that information. And so therefore the data has to be used for an FCRA purpose, which means that you do have to provide a firm offer of credit. The data itself cannot be used for determining any eligibility under FCRA. You can only use credit data to determine eligibility for a consumer. So you can't adverse action off of the data. You can, however, use the data for in sort of two unique ways. The first one is for audience selection. So what that means is that I am trying to determine which types of consumers that I want to ultimately target. So what it can, and I can use credit, or sorry, I can use property criteria to determine that. So an example of that would be, I want to go after consumers who have home values that are above $1 million, who have available equity that's of 20 or 30% and above. I'm not saying, no forbearances or delinquencies, on-time payments. I can even go down to, I want consumers that have a very specific type of roof type. I want to drill into consumers that are in a specific zip code because of my lending footprint. So you can, I want consumers that have homes that are older than 50 years because maybe they would be the most, might have the greatest propensity to convert, right, to a cash out refinance offer, for example. So you can start to look at various collateral characteristics, and this would be called audience selection. The second is a segmentation. Audience selection typically happens prior to the emergence or the conjoining of credit data with that information, right? So once credit data has been pulled in to that workflow, now you do have to deliver a firm offer of credit, especially if it's in a depersonalized situation. And you cannot use the property information for any type of suppressions or net downs, meaning you can't prevent a consumer from getting an offer because of the property data. It can only be with credit data. So usually you want to use the property data up front before any credit data is introduced. You want to do it in a depersonalized way, so you don't know who John Doe actually is. You just know, hey, they have a home that's worth $1 million. They have 20% available equity. Now, the second use case is going to be segmentation. Segmentation means that I have pulled in credit criteria, but what I'm doing is I'm segmenting these consumers into various tranches or buckets for targetability. So an example of that would be, this bucket's going to be my A consumers. A consumers can mean consumers that have 50% equity and above. These might be high movers, high propensity consumers. My B consumers might be consumers that have the following XYZ credit criteria, as well as XYZ property criteria, whatever that criteria might be. I'm going to pull in additional credit and property variables or attributes because I want to know additional information about these consumers. Everyone's going to get a firm offer. I'm just segmenting these consumers into different buckets using the property information. So those would be the two primary use cases for property data. The third one is going to be analytics. So analytics can be done both in an archive. An archive is just a fancy way of saying I'm giving you information that's depersonalized in a batch format. And what you can do with that data is you can ingest it, pull into your your Snowflake environment, your S3 bucket. You can query how you please, conjoin it with your own data, do your own pinning and matching to your own environments. It's depersonalized. There's no PII involved. You can do it for broader analytics. We also support this data in analytics using our own hosted platforms, which we call Ascend. Ascend Sandbox is exactly what it sounds like. It's a sandbox that clients can pay access to, that allows them to be able to do broad analytics using credit and property information. It's got a ton of other different data sets that are available. You can purchase off the shelf. All of these data sets are linked together using a consumer ID, or a consumer PIN, as we call. This is essentially a unique credit identifier. And then from the property side, you've got a property ID, which is a property identifier. So you can identify consumers based off their credit characteristics or any other data set, characteristics, and then also understand what their collateral characteristics are based on property ownership. So very, very cool. You could use this data for econometric analysis, geographic analysis. You can use it for marketing modeling, which what some clients are using it for. We've got some government agencies using the data. And then we've got a tool called Ascend Marketing. And what that is that it takes all of this data and it makes it available for marketing modeling. And then you can use the data for audience selection that we just talked about. It's really a platform and tool that allows you to do marketing at scale, right? At high volume, in a more technical fashion, if that makes sense. So that would be called Ascend Marketing, and you can deploy large campaigns. And I know FPN's a very fantastic power user of Ascend Marketing today, and you guys have actually been one of the first clients to resellers, rather, to actually use property information within Ascend Marketing to deploy marketing campaigns at scale. So yeah, you guys are.
Was it like the Bosley? I'm not just the founder, I'm the user too, right? FPN definitely is, as you mentioned, we do use those tools that you identified. And what I like to point out is, well, first off, just to back up a little bit, we have conversations with what I refer to as order of operations with our clients all the time, right? When to use specific data sets, how to use specific data sets to ensure that we're not running afoul of any rules or regulations, but we're still gleaning the maximum benefit, out of the data. And like you mentioned, and we do, FPN does use tools like Ascend in our daily projects with our own clients. And what I like to point out is that there is a certain client that really ought to go direct, right? They get to a certain size. I was doing a presentation actually at one of the Experian events, Experian Vision. This is a couple of years ago, and I was having a conversation. I won't name who, but they were a personal loan company, and I asked a question about something to do with their data analytics, and they had 53 data scientists, on staff, and I'm thinking, that client probably should go direct, right? But a lot of the clients that we service, they don't have that, right? They're looking for a little bit extra handholding. They're looking for a little bit extra guidance. It would take them some time to figure out tools like Audience Engine, when to use it, when not to use it, order of operations for data. So that tends to be the role that we fulfill in the marketplace, is really addressing that middle market, right? The folks that don't necessarily have their own tech stack, don't necessarily have their own data scientists or analysts on staff, and that are looking for some augmentation of their team to step into this world that is a little bit more complicated. And I do feel like that's where FPN really shines, because we do have access to these tools and resources. We have the expertise so that you don't have to, you being the end user client, don't have to employ all that expertise themselves in-house, and that they can still gain access to these very sophisticated Experian tools and data sets, but distilled down into a way that makes it a little bit easier for them to use. And then just to pick up, since we're in the implementation phase, also practically bringing things to market. So we partner with companies that can help with creative around the creation of the FOC, companies that can actually deliver the mail piece, companies that can actually tap into things like email or phone. We have our own software, so we can integrate into their solutions as well. So that's, not to turn this into an FPN pitch, but I do feel like that's the value add that we bring to this, especially that middle market that really needs to be accessing these tools, hasn't historically gotten access, was often cost prohibitive. But because we're able to aggregate our user base, we're able to gain access to these sophisticated tools and bring them to that middle market that unfortunately and historically has not had access. So
I would
go. Go ahead.
No, I totally agree. And what I was going to add to is that, you know, FPN, FPN is a very, 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 very and the important thing is to do all of what you said compliantly. And doing it compliantly is obviously the most critical thing, because the implications of not doing it compliantly, well, we know what that is. So, it's the value that sort of FPN and Experian provides in this workflow, is that we have a very deep understanding of the FCRA implications at various stages and steps of the pre-screen process, and how data can be introduced at various points in a compliant way, is sometimes more than half the battle.
Yeah.
And so, yes, we resolved the identity graph. Yes, we made it available in critical environments. But how can you actually compliantly use the data in a pre-screen workflow is actually sometimes the biggest challenge. And so, with the use of these platforms and with sort of your managed service approach, is being able to deliver that in the most compliant fashion.
Yeah, and just on that topic, to plug our future webinar series, we do have an upcoming one on firm offers themselves. We've seen a lot of times where clients see that firm offer as kind of a check the box item, something that I have to do. And in our opinion, they're not treating it the way that they should. Yes, it is absolutely a fundamental thing that needs to be done for compliance reasons, but it's also another marketing tool. Right. So we do have a future session coming up. So everybody be on the lookout for that, where we'll actually dive a little bit deeper into the rules and regulations of the firm offer to make sure that you're compliant, but also to pivot that discussion into how you can leverage that as, being a big part of your overall marketing campaign. So we covered a ton of ground here, Ivan. I am so appreciative that you joined us today. That really detailed discussion around hopefully the key takeaways. Yes, we talked specifically about property and credit data, but we also talked about, making sure that you select the right vendors, right? Ensuring that you're doing things in a compliant manner. And, when in doubt, reach out to somebody that does this for a living and piggyback, their knowledge, their expertise to ensure that you get it right. There's a lot of great resources, a lot of great software, a lot of great benefits that can be gleaned from it, but it's not without risk. Right. And so those risks need to be accounted for. That compliance needs to be maintained. And of course, we'd be happy to, help anybody that's got additional questions or needs additional assistance. So one last pause, Ivan, if there's anything that you wanted to touch on or mention, and then we'll flip it to questions for the last, 5 minutes. And we can stay on longer if we continue to have questions, but certainly want to make sure that we get everybody out of here on time. So any last comments or things to bring up?
No, I think, I think sort of just parting words would be that this is a highly regulated space. And so providing data in a highly regulated space is often very challenging. And again, we talked about the identity graph issue. We talked about stitching together disparate data sets and how difficult that can be. But it's also being able to do this in a compliant way, is having a firm understanding of what FCRA is, how the data can be used under sort of very tightly bound permissible purposes is also a very critical part of doing things right. And so I think with the quality and coverage of the data that we have today, and really the 4 or 5 year innovation now, because we've been doing this for about 5 years now, half a decade. Combined with the areas in which we've made the data available, whether it be in analytics or in batch, and the derivatives products that we've created, like the attributes and the raw data, I think has enabled us to be able to deliver value at different parts in the value chain. Whether it be for marketing or for other things. And as sort of you had mentioned, that there are continued use cases for this data beyond just marketing. I own the marketing aspects of it, but there's risk and retention, there's servicing. We're working on some capital market use cases of the data as well. So there's a lot more to this than just purely marketing.
Yep. And we had to keep it somewhat tight to cover all these topics with some very specific examples. But again, Ivan, greatly appreciate it. Don't leave quite yet, though, because Danielle, could you, are there any questions that have come up that we might be able to answer between Ivan and I?
We do have a couple of questions. The first one is, do these concepts work for personal loans? And then if they do, how do I engage with FPN to use those types of solutions?
Yeah, so I'll take that one. Evan, sounds like it was a little bit more directed towards FPM, but yeah, more broadly, yes. There may be some different considerations, right, based on different industries. Everything, as Ivan mentioned, in this regulated space, everything falls down to permissible purpose, and so do you have that permissible purpose? Provided that answer is yes, then yeah, as we mentioned at the beginning. These concepts can be deployed across various industries for different consumer-facing loan products, whether that's a mortgage loan or, as the question referenced, a personal loan. So as far as getting in touch, anybody that's joined the webinar is going to get a follow-on email. Please feel free to reach out to to FPN, and we will gladly find some time to carry that conversation further.
In addition to that one, there's one that's it's a little similar, but it actually is looking for an example. So the question was, do you have a non-mortgage example of the use of blended data, of using blended data?
That's a great question. Well, I think that I'll piggyback kind of the earlier example. Again, it was tailored to mortgage, and maybe I'm going down the integrated data path a little bit more than the blended data path, but certainly as Ivan was discussing throughout, right, the that identity resolution piece, right, that identity graph. That type of understanding is going to also cross industry, cross product, because being able to understand, any data point from any of those single sources, how it relates to other sources, is not necessarily industry or product specific. So I think that's maybe a more general answer, but Ivan, any additional commentary maybe around some non-mortgage use cases that you've seen clients deploy these strategies in?
Yeah, a lot to unpack there. So short answer is that, and I think I'll answer the question prior to this one because it kind of leads into the answer to this one. So property data cannot unfortunately be used to originate non-mortgage loans. So personal loans. However, it can be used in a variety of compliant ways, which will, we would have to unpack that with you in a follow-up discussion, maybe offline, but you can use it for audience selection, especially in a depersonalized way. But you can't make selections. You can't make deterministic offers using property data for like a personal loan. And that's because this is really information relating to collateral that you'd be using, and if it had any bearing on the qualification of a consumer for a personal loan, then you kind of get into some gray areas. So it's a little more to unpack there, but typically the answer is no around that. But there are ways to be able to use it in a compliant way. And again, this is one of the reasons why you'd want it to sort of elicit the help of an FPN or experience, because we can help you kind of get there. And the other thing is, in terms of blended data that exists that's beyond sort of mortgage use cases. There's a lot that exists at Experian, and FPN can sort of direct you to as well. We've got cash flow attributes, and this is going to be consumer insights that are pertain to deposit account sort of debits and credits. And those can get blended with a wide variety of other data assets to be able to understand as a proxy to consumer borrower health. And there's a wide variety of use cases around that. That's not particularly sort of property data based. We've got trended data and historical trended data around consumers using credit information. We've got rental data, rent bureau data, which is kind of very interesting. That's say, specifically property database. We've got a whole section within Experian that's dedicated to marketing and demographic data. They've got a number of different sort of psychographic data segments, right? Household data, behavioral patterns, buying and shopping habits, different sort of characteristics of a consumer that are targetable. Those types of insights can be used on the front end for audience selection, so you can understand what types of consumers you want to target. Also, something that's available in our Ascend environment and Ascend marketing. It's actively used today by a lot of end users. So there's a lot there. I think that warrants kind of a follow-up discussion potentially, but that's kind of going to be the short answer. Yeah.
Yeah, and I think that's a perfect segue. To be respectful of everybody's time, make sure that we wrap up at 3 here. Thank you so much for joining us, Ivan. Thank you so much for everything you shared with us today. Definitely, learned quite a few things. Not just that the two companies were at 1.1. But many other, interesting things, and greatly appreciate that. Please do check out the upcoming webinar series. Same place that you registered for this event, you can register for other events. We will be talking about FICO and Vantage Score. We have an upcoming one on firm offers of credit. We're going to be working on some different unique implementation campaign strategies with TrustEngine. So we've got some great things coming up, and look forward to having y'all join us in the future. And once again, Ivan, thank you so much for joining us today, and for all of the valuable information that you brought to this discussion.
Thanks for having me.
Great. Thank you so much.
All right. Thank you, everybody. I appreciate your time, and on behalf of the entire team, we appreciate your engagement. We look forward to seeing how you put all of these new insights into action, and please make sure to sign up for our next session. Ryan already spoke to it. The title is From Transactional to Relational, a Data-Driven Lending Philosophy. That one is scheduled for Wednesday, December 3rd at 2 o'clock Eastern Standard Time. That one will feature Tyler Sawyer, President of FPN, and then Dave Savage, Chief Innovation Officer of TrustEngine. Take care, and we will see you next time.
Great. Thank you.